So throughout the next 12 weeks, we're going to talk about Alex and Alex's fictitious software company. It's turning over about $1 million. And you can see that year on year, this business has actually stayed flat or gone down very slightly from 1,000,003 to 1,000,001. Gross profit on those sales, they made 341k profit last year. That actually increased. Profit margin has gone up by 1%, and the gross profit's gone up from 340 to 350, an extra £10,000. Overheads at the same time have gone down by 10 grand, and that means that the net profit has gone up by nearly £20,000. No, not due to sales moving, but due to gross profit improving and overheads reducing. So let's talk about success. What is success in business? Now, if you look at that there, there's 3 ways I can increase my profit. I can increase my profit, I can increase my sales, or I can decrease my overheads. We're going to look at one of those scenarios. Let's look at what would happen for Alex's business if Alex was to increase revenue by 50%. So it's going to be quite hard work, but we're going to go from 1 million to 1.5 million. It's a $500,000 increase in revenue sales. Gross profit will go up if we hold all our ratios the same. If our overheads go up in proportion, we get a net profit increase of a healthy £40,000 additional profit, or 39,710. And you can see we're going up from 79 last year to 119 to enjoy a very profitable, very successful year. Let's talk about it in a bit more detail. So question, are you successfully growing your business, or are you actually unwittingly bankrupting your business? Now, the answer will depend on some other things. In particular, your understanding of the cash flow cycle for businesses. So let's go through that. Cash flow, you buy stuff. And now in accounting terms, that is accounted for on your financial reports on your balance sheet, in particular as the creditors. So these are the people that you bought goods from. You haven't paid for it yet, but you still owe them. So those are your creditors. You bought stuff. Having bought it and paid for it, you own it. So that's sat there on your balance sheet as stock or work in progress. And then at some point, hopefully, you're going to sell it. And when you sell it, if you're in a cash business, you're going to realize whatever profit you've made immediately. But if you're in a position where you give trade credit, then you're going to have to wait to get paid. And these are accounted for as debtors. And the problem with this is there is a time delay. There is a potentially very large time delay between the buying it, paying for it, storing it, working on it, adding labor to it, work in progress, and eventually selling it, and then waiting until eventually, maybe in some cases, you raise the invoice, and then eventually still later, the client actually gets around to paying it. And that's a problem. That is a huge problem. Now, if the business is steady state, as in sales are pretty flat and things aren't moving, then your creditors, your stock, work in progress, your debtors stay more or less the same. But what happens if you're growing? What happens if we make a 50% increase in turnover? Well, the answer is this, is the amount of cash I have tied up in my business, the amount of working capital goes up, the debtors go up and up as I keep growing. Now, that money has to come from somewhere, because I can't get the money back in until the clients pay the bill. So paying suppliers, we've got some more metrics. We've got some cash flow metrics now. Do you track the time it takes you to pay your suppliers? Do you systematically go and engage with your suppliers and ask for better payment terms? In that round, do you look at what alternative suppliers might offer, either as a negotiating tactic or genuinely to look at switching suppliers? Do other businesses get better terms than you? In which case, why? What can you do? And bottom line is, please do track all of this, but do track the time it takes to pay suppliers, because this inevitably creeps up if you're not paying attention to it. Stock and work in progress, especially work in progress, needs to be accounted for or managed. So you need to know how much stock or how much work in progress is tied up in your business. In other words, your money tied up in the business that you haven't even sold yet. Do you have to stock everything you sell? Frequently, we find businesses that have got stock on the shelves that they really don't need to hold, which is, again, tying up cash. That could be converted from stock to cash. Could you reduce lead times? I think, can you get stock in faster from your suppliers, which means you have to hold less stock? And what is a good target for stock reduction? Because anything you can do to reduce stock will improve stock turns, will improve your cash position ultimately. You need to know how much stock you're holding. That ought to be something you're checking on a regular basis. Getting paid. Do you track how long it takes customers to pay you? Do you have a credit control process, a very robust credit control process to remind people to pay you, get them to pay you as early as possible? Could you potentially reduce your payment terms? So instead of giving 90 days or 60 days or whatever period, 45 days, could you get your payment terms down to 2 weeks, 1 week? The answer is probably more so than you think you can. Should you put bad players on pro forma? I'll answer that one. Yes, you should. A bad payer is not a good customer. They never can be. They're a liability for your business and your cash flow. But you really do need to track and need to be managing how long it takes customers to pay, and you need to be trying to work to get that number down. This is why. If you can make these improvements, ultimately the cash tied up in your business or the amount of cash you need to grow basically reduces. So the amount of cash tied in stock and work in progress and in debtors reduces, and that is just that reduces your bank balance or puts more cash back into your bank's balance, depending on the positive or negative. So here's Alex. Alex, in our case here, we're going to have Alex as a husband and wife team, both called Alex. I genuinely used to employ a salesman in France. He and his wife were both called Pascal. Don't know how they got on. That must have been quite complicated. Anyway, Alex's dividend dilemma. Debtor days, creditor days, £190,000 owed to the business by the suppliers. Last year, it was taking them 69.1 days to pay. Creditors, money borrowed from suppliers that hasn't been paid yet, was running at 31 days. A year later, the total debtors have increased. It's taking 72 days to get paid, and we've got £197,000 of our cash in somebody else's bank account. In other words, it's taking 3 days longer. Creditor days, well, that's gone down. Effectively, we're borrowing less from our suppliers, quite a lot less, because we're paying them 4 days faster. And what's happening to Alex's start point in the bank position, because of course this year has happened, we're still looking at history. Start point there is the cash in bank minus 53,000, 53k overdraft. So we look at the scenario we spoke about, the 50% increase in sales. The start point for the bank, remember, is minus £53,000. So if we generate an extra 50% sales, £500,000, that generated nearly £40,000 of increased profit. That's good news. That improves the bank position. Excellent. Obviously, the first thing we've got to do if we're going to sell more is buy more. So we're also going to borrow more from our creditors. So we're actually borrowing an extra £34,000 from creditors. So these both have a positive impact on the bank. Add them together, you've got nearly 40,000 plus 34, £74,000 better off at this stage. However, we've also got cash tied up in our debtors. And that's gone down. That's gone way down. That's gone down by 98,000. So we're nearly £100,000 worse off, but only 70,000 positive. So net position in terms of the cash in bank at the start, it's gone down from minus 53 to minus 77. Or has it? If you need to borrow the money and the bank will lend it, then maybe it has. But if you need to borrow the money, and that is the difference between staying in business and not being in business, and you cannot borrow the extra money, remember, you need an extra nearly 25 grand, you're potentially out of business. Or you just put another director's guarantee to guarantee it, and have you told the other half that the house is now on the line? Maybe not go there. Let's move on. So that's what happens if we don't do anything else other than just focus on sales. If we did something else, let's focus on sales. We get that 50% increase in sales, and at the same time we'll focus on credit control. We only look at one aspect of credit control. We'd look at getting the debtor days down from 72 down to 40. Net profit was still increased by the same amount. That's gone up. Great. Creditors, we're borrowing more money from the creditors. That's the same number. That's gone up as well. But because we've now got the debtor days down, even with a higher volume of sales, guess what? We've actually got a positive movement in the debtors. So I've got 3 new pots of money coming into my bank, which means my net bank position closes at the end of the year positive 53k. Fantastic news. Bottom line is I've got £106,000 of additional cash in the bank by executing this strategy. Now, the only flaw with this at the moment is it's going to be bloody hard work doing 50% of everything. An alternative strategy might be to let's just focus on credit control. Get somebody in to focus on credit control, use the right tech, etc., set things up properly, and we'll just leave sales revenue unchanged. We did a flat line last year. Let's stay flat line. Net profit goes up. Fantastic. Creditors go up. Fantastic. And by doing the credit control, even with revenue the same, it's not quite as dramatic as before, but our debtors are still going to improve. So we've got, again, 3 positive impacts on the bank. Net position at the end of the year is our cash position will be, I think that number's slightly wrong, actually. Yeah, that slide's actually wrong. It should be more like 87. So I'm not quite sure what happened to that slide. I do apologize. The message, underlying message is still the same. However, it's just you need to focus on understanding your credit cycle, and you need to be clear on exactly what would happen to the business. So there are 7 drivers for sales and increased profit. I've added one more in here. The one more I've added is cash flow. And cash flow technically could be 3: the debtors, the creditors, the stock work in progress. The other 6 are all driving profit, which is margins, overheads, acquisition, retention, transaction value, and purchase frequency.